One of the first questions every entrepreneur asks is, what type of business should I register? This decision shapes your tax, personal risk, growth, and how seriously people take your business. Many entrepreneurs rush this step, registering what sounds easiest or cheapest, only to realize later they chose the wrong structure. Changing it can be costly, stressful, and disruptive. So, let's slow things down and talk about this properly. In South Africa, the three most common business entities are Sole Proprietor, Private Company PI Ltd, and Nonprofit Organization NPO. Each one has its place and can either help or hurt your business depending on your goals. A sole proprietor is the simplest business form. No separate legal entity, you and the business are the same person. This is where most hustles start. You trade under your own name or a trading name. Income flows directly into your personal bank account, and everything is declared under your personal tax return. People choose this structure for easy start, no CIPC registration, low administration, and relative cheapness. It's common for freelancers, consultants, content creators, small traders, and side hustles. The biggest risk most people ignore is that there is no protection at all. If the business owes money, you owe money. If something goes wrong, your personal assets are at risk. Your personal bank account can be attached, and SARS treats all income as your personal income. This may be manageable when income is small, but it becomes dangerous as the business grows. You're taxed at personal rates, increasing with income, with no separation between business and personal tax. A sole proprietorship makes sense when testing an idea, earning a regular income, or just starting out. It's also suitable for operating with low risk and not planning to scale yet. For most entrepreneurs, however, it's a temporary structure rather than a long-term solution. A private company or PI Ltd is the most popular structure for growing businesses in South Africa. This is where your business becomes its own legal person, completely separate from you. The company is registered with CIPC, has its own registration number, tax number, and bank account. Managed by directors and shareholders, in simple terms, the business is the business and you are you. Entrepreneurs choose a PI Ltd for limited liability, professionalism, easier funding, and scaling. It also creates a clean separation between personal and business finances. It is common for growing SMS, construction companies, transport businesses, agencies, retail operations, and online brands. One of the most misunderstood benefits of a PI Limited is protection if the company fails. The company owes the money, not you personally, unless you have signed personal surety. For many entrepreneurs, that protection alone makes this structure worth it. From a tax perspective, companies are taxed at a fixed rate rather than progressive personal rates, making tax planning easier, expenses clearer, and directors still declare salaries or dividends personally. This gives more control over how tax is managed. That said, a private limited does come with responsibilities, annual returns, beneficial ownership filings, and company tax returns. Also bookkeeping and ongoing compliance, but the reality is simple. Structure costs money, while chaos costs more. A private limited makes sense when you want to grow, protect yourself, build credibility, and access funding or tenders. It's also for maintaining clean separation and building something long-term. For many entrepreneurs, this becomes the right move once income is consistent. An NPO, or nonprofit organization, is often misunderstood. Many people hear nonprofit and assume it means no money can be made. That's not true. An NPO can generate income, but it cannot distribute profits to individuals. Any surplus must be reinvested into the organization's purpose. NPOs are registered with CIPC and the Department of Social Development and governed by a constitution. They operate for a public or community benefit. They are common for NGOs, community projects, and foundations. Also churches, educational initiatives, and social upliftment programs. The most important rule is that money cannot be paid out as profit to founders. From a tax perspective, NPOs can apply for tax exemptions but must still submit returns and meet strict reporting requirements. Misuse of funds can lead to serious penalties. An NPO makes sense if your goal is social impact, donor funding, and community benefit. If profit distribution is not your objective, and if your goal is personal income or commercial growth, an NPO is not the right structure. So, which structure should you choose? The honest answer is that it depends on your income level, risk exposure, and growth plans. And your long-term vision, a sole proprietor is easy and cheap but risky and best suited to the early stages. A PILTD is professional, protected, structured, and scalable, making it ideal for growth. NPO is purpose-driven, regulated, and designed for impact work rather than profit. The biggest mistake many entrepreneurs make is choosing a structure based only on what's cheapest today, instead of what will protect them tomorrow. Many start as sole proprietors, grow quickly, make serious money, then get hit with tax, liability, or legal issues and panic. An organized entrepreneur plans ahead. Your business structure is not just paperwork, it's a strategy. It affects your money, your risk, your stress levels, your growth, and your future. Choose the structure that matches where you're going, not just where you are today. When your foundation is right, everything else becomes easier.